Welcome to the Broken Pie Chart Podcast, episode 321. I'm your host, Derek Moore. All right, everyone's trying to figure out whether or not there's going to be a recession. And I've been seeing a lot of commentary like the market will do X if there's a recession. If there's no recession, it will do Y. I was traveling this week, and I used to travel, better part of 10 years, I was traveling every week. And one of the things I used to pay attention to, I parked in the same garage when I went on my trips. And I was usually, well, it depends how long I was gone, but it was literally like every week I was traveling for a while. And I would pay attention to where I had to park. In other words, like, did I had to go on the very top level, which was uncovered, level 7, level, whatever the levels were. And I remember going right before, this would have been 2007, 2008, 2009. And one of the ways you knew that things were bad, and you saw this in 2000, 2001, 2002 as well, is all of us, you started to be able to park on lower and lower levels. And when things are really good, usually all those spots are filled and you have to sort of park, way up top. Now, the reality is it really doesn't matter because unless you're parked on the same level of the gates, you still have to take an elevator down. But I would pay attention to this. And I used to I kept a yellow pad and I would write down like where I parked. I remember in the probably right around March of 2009, I would park so close to the gates. Like you could park wherever you wanted because a lot of the business travel had stopped and that was kind of the lows. Now, I'm not saying that called the low, but it was kind of matching up that way. This week I traveled, and I will tell you that Phoenix Sky Harbor Airport, and I went to Newark Airport in New Jersey. Those two airports were absolutely packed. Absolutely packed. When I flew out of Newark pretty early in the morning, packed. Absolutely packed. Like security lines and even TSA line. You had to sort of wait. And I'll tell you, props to Newark. That was a dump, that airport. And I hadn't been to that terminal in a while. And they have a new Terminal A. It's actually really nice. Concourses are really wide, high ceilings. So good job, Newark. Good job, Newark. But getting back to the recession thing, travel is a lagging indicator because a lot of people, especially leisure travelers, they will book their trips ahead of time and they're not necessarily going to cancel. But, there's just these little things in the economy that you can sort of watch. And it doesn't mean anything all by themselves, but sometimes you stack these things up and it does mean something. I would tell you the hotels I went to this week, packed. They were packed. Like you could tell, the restaurants downstairs, packed. So does that mean we're not having a recession? Of course not. Who knows? I'm just saying that my little indicator there, the travel indicator, is not showing a recession right now. Charlie Bolello put out something from the Wall Street Journal. He reposted a graph that was in the WSJ. The average response in each survey, Wall Street Journal survey of economists, likelihood of a recession in the next 12 months. And it spiked in the April survey to 45% likelihood. It was probably, I don't know, I'm guessing 23% in the previous survey. And you might say, well, that's alarming. That means we're going to have a recession. But the problem is, in 2023, the end of 2022, beginning of 2023, I think it was like 63%, 61%, 60% likelihood of recession in the next 12 months. Remember what happened there? Remember I always say, what was it? 29 of the 30 leading economists were calling for a recession. So you really don't know. You really don't know. And there's a lot of groupthink here. And I think, if you're an economist and you're getting surveyed, is it harder to say, no, I don't think there's going to be a recession? Or is it easier just to sort of go along so that you don't kind of look like you missed it, like it was so obvious? So just something to keep an eye on. But definitely recession expectations are rising As I said, in travel, it was packed. Planes were packed. Gates were packed. People are traveling. All right. One of the things sticking on the recession is high yield spreads. And high yield spreads, they widened to, let's see, around 491 basis points. And what does that mean? Well, quite simply, it's if the yield to maturity, let's say, is here, I'll give it an easier example. If the yield to maturity is 8.5% on high yield bonds and treasuries, the yield to maturity is 4%. That difference between 8.5% and 4% is 4.5 percentage points or 450 basis points. So basis points is just a fancy way for, like, if something went from 450 to 451, you would say it went up by 1 basis point or 1 BPS. So why is that interesting? Well, so far, high yield bonds are not pricing in necessarily a recession. And this is from Charlie Bolello as well. Charlie says, U.S. high yield credit spreads hit a peak of 461. Oh, did I say 491? 461 last week, but are nowhere near pricing in a recessionary default cycle. During the past 3 recessions, high yield spreads crossed above 1,000 basis points during recessions. And he's got a little graph here. And, you know, when you look at this, you see February 2020, March 2020, peak high yield spread, 1,087 basis points. Remember, that's the spread between the yield to maturity on treasuries and yield to maturity on high yield. And the reason why this spread blows out or increases is because if people are selling high yield bonds, the price is going down and the yield to maturity is going up. Now you look at this too. Okay, so that was a recession. October 2007 to March of 2009. Yes, there was a recession. 2182 basis points. They really blew out then. That's a massive, massive widening. And that's one of those things too. That was in hindsight, what an opportunity that was to buy high yield bonds. Seeing that spread that wide. I think I remember talking about, there was some data, and thanks to our friends from State Street on this, where I think JP Morgan had put out a piece. And if you bought high yield bonds when the spread was 1,000 or more, none of those times would the investor have lost money 1 year later. Meaning when spreads blow out, it's more of a good time to buy than not buy. Now, again, I don't know what's going to happen, but this is what some of the numbers said in this JP Morgan piece. And then you look at spreads blew out to 1120 March 2000 to October 2002. And recession there. And so when you look at the recessions, or when there was a recession, the most recent ones, yeah, I mean, they were above 1,000. And so they're not really pricing in these massive, defaults. They're not really pricing in necessarily recession yet. That could change. That could absolutely change. The other thing that's kind of interesting too is that gold made another all-time high today, or this week, I guess. I don't remember what day it was. And I was thinking with Charlie Bolello has got some nice graphs today. So 2025 plus 27.7% year-to-date return. That was as of 2 days ago. 2024 plus 26%. 2023 plus 13%. Gold's had a nice little run. And that's the year-to-date so far. I mean, who knows what it's going to close at for the year. But it's the highest return since 1979 when gold returned for the year, 126.5%. Wow, that was a return for gold. So does that mean you should go out and buy a bunch of gold right now? Not necessarily, but if that's in your portfolio as part of a diversified strategy, it's doing its job. We've got that in a strategy I call decades, Zega decades. And that strategy holds a little bit of gold there. That's been doing nice for that portfolio. So, but it doesn't mean you go out and buy it. In fact, sometimes what happens is and you see this even with professional fund managers. And by the way, if I haven't mentioned it already, I'm a little under the weather. That's why my voice sounds a little off. But there was a survey, B of A Global Fund Manager Survey, and this was, December of 24. Basically, what is this? US equity allocation surged to a record high. Meaning people are, and this is fund manager survey. So fund managers we're loading up on US equities and overweight US equities. And it's uncanny, right? And what happens? Well, recently they did a survey and they said, how many of you are looking at getting out of US equities? And I've got to find the survey. If I can find, I'll tell you the exact percent, but that's gone up. No surprise. No surprise there. Even professional fund managers are like, oh, now you plan on getting out of US equities. Really? You didn't do it at the all-time high. You didn't do it at the high of the Mag 7 back in, when was that? December. You didn't do it then. Now you're going to do it. And so it's a good reminder of how even the professionals sometimes chase what the best returns are or sell things after they've already gone down. Like, they don't know. They really don't know. And I think it's a good lesson of sometimes do less. Sometimes just, if you decide on strategies, you stick with them, and you don't want to make rash decisions where you're saying, oh, maybe I'll get out now. You got to be right twice. You got to know when to get out, and got to know when to get back in. Good luck with that. All right. I think this was All Star Charts on Twitter, or one of the people from that group had posted a chart, and it said flows into money market and cash ETFs, 3-month rolling average. No surprise, it's really high. People are rotating out of stocks at the most recent low and going to cash. Remember, they didn't time it and get out at the absolute high. They're doing it now. And there's a quote on here from Peter Lynch. It says, the key to making money in stocks is to not get scared out of them. The key to making money in stocks is to not get scared out of them. Peter Lynch, remember we talked about that, the 1994 talk, where he said, a 10% correction is going to happen once every 2 years, 53 times out of the last 94 years. And if that's something that you can't handle, maybe stocks aren't for you. I'm paraphrasing. And I will tell you that we know that everyone's situation is different. And that's why I'm a big fan of still owning the market, having time in the market, but having hedges. Because when you have hedges, it takes away that sort of need to, should I sell now? Should I go to cash? You probably, if you're panicking, if you're making emotional decisions, you're probably making the wrong decision. Another thing somebody asked me recently was, does this period in the market remind you of anything? And remember, they're all the same, but they're all a little different. And I thought about it for a second. And I said, you know what? It's not the same, but it's same-ish in this regard. 1998 had the Thai baht crisis, the Asian contagion. And I remember that, U.S. stocks held up even when some of the emerging markets were just really getting roiled, really getting killed. And there's stuff that's up this year. We just talked about gold, but we also can see UEFA developed Europe is up. Germany's up. China's up. Now, China had sold off quite a bit, but okay. You have these, it's not all like, in 2008, 2009, everything went down. Everything went down. Everything went down. But you do have some pockets. And then the next question was, well, does that mean I should go buy international stocks now? Remember what I just said? You're going to have people say, well, I'm going to rotate international after they're up relative to US equities. Like, really? You're going to do it now? Now's the right time to do it? I don't know if it's going to be the right time to do it or not. But this is one of the reasons why I wish some retail investors stop watching CNBC, stop going online and looking at opinions, because what the expert says 3 weeks ago is different from what they say now. And imagine that you are making investment decisions based upon what somebody goes on and has a 1 minute spot on CNBC and says something. It's not a great way to build a portfolio or to manage a portfolio. We talked about gold and how I'm sure people are going to look at gold and say, I'm going to sell treasuries and buy gold. And there was something from Isabel Net on Twitter. Gold is increasingly being positioned as an alternative to U.S. Treasury bonds. And that's from Deutsche Bank. Yeah, this is Deutsche Bank, and Bloomberg has this chart. And it's gold positions itself as Treasury bond alternative. Is this a good idea? I don't know. But you're not early to this. And here's what's happening. Normally, when there's a market, and I say normally because there's more correlation between bonds and stocks, especially over the last, 20 years or so than you think. And what that means is bonds are going down at the same time stocks are going down. And we've seen that recently where you have treasury yields going higher. The treasury curve had uninverted, then reinverted, meaning the short-term rates are higher than the long-term rates. The thing that's different about owning I'm not suggesting you go out and buy a bunch of treasuries. And whether or not you go out on the long end of the curve, that has the most risk when interest rates go up, bond prices go down, and the further out time to maturity and the relative change to a 1% move up or down in rates. But if rates went up, you'd expect the long end stuff to go down more. But the thing that's different now is that you are getting, between 4.5%, 1.5% for bonds. That's a lot different than when you were getting 1% on, let's say, a 30-year treasury. I think 30 years went down that far. 10-year was under 1. So you are getting paid more of a coupon. Now, I'm not suggesting that you go back to a 60-40 portfolio. In fact, I just told you that these things become more correlated when markets are stressed. The easy trade to do, if you knew this was going to come about, you would say, well, I'll buy bonds, I'll buy treasuries because there'll be a flight to quality, and I'll buy the US dollar. And the dollar's gone down, and treasuries have gone down because interest rates have gone up, not down. So it's been some of the flight to safety trades are not working right now. But it is different, and having a 4% plus yield as opposed to when you're looking at 5 years and out, I think that stuff is all 4 years and higher. What about the VIX? We've been speaking about how the VIX has not been accurately predicting certainly the intraday volatility, and then the day-to-day volatility. Not that. It's this period where, in general, the VIX Index has been purporting or predicting less volatility than actual volatility. And what was it? Thursday? What was it? Thursday? Let me get the date right here. Yeah. So coming in, Tuesday the 15th, market closes, and then the next day it closes down, about minus 2.25, 2.25. And you say, well, it was the 15th, right? 15th, at the end of the day, it was a little bit over 30. So is it accurately predicting what the actual volatility was on a close-to-close basis? Well, at 30, what did I say? 30.12 divided by 15.875. No, it's not. 30.12 divided by 15.875, about 1.9%. One standard deviation move. What did I just tell you? It was like 2.25. So it's not. We're still seeing where the VIX And look, I mean, the VIX is in this period where you actually, I mean, you're seeing more volatility in the VIX's pricing, right? That's the problem right now, and it's continuing to see that. And I know it was just 2.25%, but at one point the change was a little higher than that. So the VIX still is not really predicting is not the right word, but pricing in the right amount of actual volatility. And if you're new to the program, just understand that when the market predicts volatility vis-a-vis implied volatility of options on equities or options on ETF or the VIX, that is the implied volatility. It's implied in the price, and it says basically, based on the price of the options, the market is predicting a one standard deviation range of X. What actually happens is historical volatility, and it's what actually happened. The change from day to day, or a change from one week to another week. And so it's still not accurately, portraying what really the actual volatility is. I mean, United Healthcare this week, they came out with some guidance that was not priced in. I think it was down 20 something percent in a single day. So, those things are not priced in. And I guess it's kind of a surprise announcement, but that was not priced in. So keep an eye on that. Continue to keep an eye on that. And I think what you'll see is that when markets start to ease out, I mean, it's gotten better, but I think when markets start to sort of, get back to normal, if they get back to normal, I don't know if they will, but if they get back to normal, you'd expect to see that regime restart where implied volatility is pricing in greater moves than actually happen. And finally, here's something else I'm watching. At heart, I'm a technical analyst, and I love technicals. I love the charts. I do look at fundamentals too. Well, actually, I said finally, a little bit of tech, a little bit of fundamentals. Bar chart had a tweet out, and they mentioned that the S&P 500 is coming in for a test of its 200-week moving average. This is held as support for the last 15 years, with the lone exception of a wick down during the COVID scare. So kind of that's another thing to watch for, these moving average lines and the 200. The 200 is still upsloping. And if you believe that this is going to hold, you would expect it to bounce off there. And by the way, it would have to get lower. I mean, I think it's around 4,700 right now. That will continue to move up and to the right as it takes every week that passes. 1 week lops off from a while ago and another week comes on. But, that's something that's interesting. Fundamentals, yeah, big earnings week coming. We've got Tesla after the close Tuesday. Let me see who else is in here. Yeah, Alphabet / Google. They are after the close Thursday. And Chipotle, yeah, it's kind of a economic consumer thing, right? They're I don't know. I mean, they're not supporting as Tesla and Alphabet as far as earnings, but there's a couple in here. And then the following week is where really, really starts to ramp up for earnings. I say this because remember I've been talking about how the analyst estimates, the consensus for the forward 12-month blended estimate, according to Bloomberg, is 266.25 a share. So that's lower than the 271. And based upon where the market is, that's 19.84 times forward 12-month estimates. Estimates, I stress, can be changed. We've already seen them changed. So this is a little bit of a tough one because right now, I think we're going to go through this period, see if companies give guidance. Some companies aren't giving guidance. Like, what was it, United Airlines? Didn't they do hey, if there's a recession, here's our guidance. If there's no recession, here's our guidance. Okay. I don't think that's incredibly helpful. Like, it's like, of course, you're going to not make as much if there's a recession. Are you saying there's going to be a recession? But watch this, because I think as we get through earnings and maybe there's a little more certainty on the tariffs, you're going to see analysts start to update their forecast. And earnings, even at that price or that level, 8.36% year-over-year growth is forecast, which is pretty good. If you look at sales per share, sales is supposed to grow about 4.54. So, that's not bad. I think a lot of people would take that. They'd rather 271, but I think a lot of people would take that. There are some firms that I've already lowered. Remember, this is a consensus. So it's sort of whether it's the median or the average. And some firms I've seen have gone down to 250. They've discounted down the earnings. But let's keep an eye on this one. And what I would tell you too is a lot of times the market moves prior to the actual event. So a lot of times you'll see the market price in things in the future. In other words, if there is going to be a recession, the market would discount that before the actual recession. And sometimes what happens is, and sometimes, I'm not saying all the time, when you're in the recession, the market is sort of already basing or finding a bottom or finding, its feet and turning up before the end of the recession. We'll see what happens this year. And I'm not saying there's going to be a recession. I just told you the airport was absolutely packed. I know that's a lagging indicator. I know that. It's just one thing I look at. All right, I'm going to call it there. My voice is struggling a little bit. Hopefully that gives you some good info on some of the goings on. It's sort of mixed. And I think it's one of these periods where if you set up your strategies, especially if you have hedged equity or have other things, like try not to pay attention. Try not to get too crazy watching the news and watching people try and make predictions. Most likely they're going to be wrong. All right, everyone. Oh, recommendations. I watched The Infiltrator. So that's with Bryan Cranston. I think he's working, is it FBI? Yeah, I think it's the FBI, and he infiltrates Colombian drug cartels as a guy who launders money. It's a movie, which I like. I'm all in for movies. Like, give me 2 hours. You're in. You're done. Would I watch it again? I'm not sure, but it was really entertaining for the time that I watched it. So I'll give a recommendation for that. And then I watched The Lincoln Lawyer. That's a series, not to be confused with the movie. I was a little hesitant because I'm sort of anchored to the idea of, the Matthew McConaughey movie, which I thought was really good. And by the way, if you haven't seen that movie, watch the movie. But there's a series, and it's pretty good. The guy who plays the Lincoln Lawyer is pretty good. So that's kind of the recommendations. Paradise. I feel maybe I'm a contrarian on this. I didn't like how it ended. I didn't like how it sort of wound down. And maybe I'm wrong on this, but I'm not sure I'm going to watch season 2 if there is one. I assume there's going to be one because they sort of set it up. One of the characters is going to do some stuff in the future, but I don't know. I did like it. I think it's good. It had its moments. I don't like the way they wound it down. I'm sorry. All right, everyone. We'll talk to you next week. Bye.